Welcome back. This is not financial advice. I'm going to ask you to like the video, subscribe to the channel, and hit the bell. And we're going to jump right into today's topic. So today we're going to be discussing the four defensive sectors within the S&P 500. And so over the last year, the market is up 8.7%. And a lot of that growth has been driven by what's referred to as the Magnificent Seven, which in the past have been referred to as FANG stocks. Talking about Facebook, Apple, Google, etc. Nvidia is now included in that. And so these seven stocks have driven something like 40% of the returns of the entire market over the last year, where we're up 8.7%. Looking back on the market, it's up 9.8% year to date. Interestingly, the market is flat over the last 6 months, up 0.62% in the last 6 months, and also up 0.6% today, trading down a little bit after hours. So let's take a look at the four defensive sectors within the S&P 500 and see what we can learn about these together. So the first sector that we're going to look at is aerospace and defense. This is literally a defensive sector because these are war stocks. And so the concept behind investing rather in this category is that this stock is literally a defensive stock as it's buying war stocks. So Lockheed Martin, Northrop Grumman, companies that produce military equipment and technology predominantly for the United States government. And so a thesis on this can be that in the same way you could buy a treasury note or bond from the government and expect to have your money returned with a yield, you can also expect that the United States government is going to continue to spend money on war. We have one of the largest defense budgets in the world, in fact, the largest, and it's not likely to change anytime soon. And so, my particular pick for this defensive sector in the S&P 500 is State Street Spider's XAR ETF. In blue here, you can see that over the last dozen years, it's trounced the S&P 500, returning 354% to 263% for the market. Let's talk about that a little bit more. So this company, this ETF rather, XAR, has an expense ratio of 0.35%, which is a little bit lower than the average expense ratio for other aerospace and defense ETFs. One note that's interesting about this, a couple of sub industry stocks that are swept up into this are going to be firearm stocks like Ruger and Smith and Wesson. But these are generally your big stocks like Northrop Grumman, Lockheed Martin, etc. Um, and so there's something that sets this one apart that is worth paying attention to. But this ETF seeks to provide investment results that before fees expenses generally correspond to the total return performance of the S&P Aerospace Defense Select Industry Index. And we're going to talk about that now. So XAR seeks to track a modified equal weight index, which provides for potential and on-concentrated industry exposure across large, mid, and small cap stocks. And so most defense sector ETFs have a higher concentration with older, slow growing, high dividend names like Lockheed Martin and Northrop Grumman. But this is going to include some small and mid cap stocks. And so it's going to capture some of that price performance as a small cap defense stock becomes a mid cap and a mid cap becomes a large cap. And so this is an ETF that has a lower expense ratio than the competition. I'm fairly agnostic to having the small and mid cap stocks included, but this is just the ETF and my exposure to the sector that I'm interested in. So again, expense ratio 0.35, which is one of the lower ones in this category. Overall, it's pretty high, but that's the price to play. So 32 total stocks within this ETF. If I'm looking at this right, the average market cap might be $2.8 billion, which means that a lot of these are quite small, quite small stocks here. And so we can also see price to earnings ratio of around 22%, which is pretty high. And looking at this stock, the most recent dividend yield is very low at about 0.6% on the dividend yield. It's going to be with a lot of those smaller companies being included in there. It's just the way that I like to play it, but there's other options, and we'll discuss some of those as well. But looking at the top 10 holdings, frankly, Spirit Aerospace Systems Holding, don't even know who they are. And so we can see companies that we recognize: Northrop Grumman, 5%, General Dynamics, 5%, Lockheed Martin, 4.5%, L3 Harris, 4.5%. Huntington Ingalls, 4 1/3%. And then it's getting into a lot of these smaller companies. I recognize some of them, others may not, but this is one that is not very heavily weighted towards the top. So you can take that for what it's worth. Um, I guess I'll just take a side note out in a second, for a second to talk about ETFs and the S&P 500 versus individual stocks. And as I'm doing that, I'll ask you to like the video and subscribe to the channel. But, one thing that I've learned over the last 2.5 years of investing is that beating the S&P 500 is quite hard. And so, you have this comment or this thought: do you buy undervalued stocks and wait for them to go up? Do you ride momentum? And essentially, the ETFs that I do buy, although they may not be broad market ETFs all the time, they all are market cap weighted. And so what that means is the more the price of a stock goes up, the larger that company is represented within the S&P 500 or within the total US stock market. And so ETFs that are market cap weighted are going to take a stock that's weighted lightly, and if it grows, it's going to capture that growth and buy more of it as it's on its way up. And so an ETF is something that will sort of use the efficient market theory, that a lot of people know a lot of different things about stocks, and stocks go up or down for a reason. And so you get exposure to companies that are being rewarded by the market, and you reduce your exposure to companies that are not doing so well. And so it's challenging for someone with a value investor mindset to admit how strong the performance of market cap weighting or even total, market ETFs are. But all the same, we're going to keep on keeping on with that little aside. So this gives us an understanding of what we're looking at for our first of 4 defensive sectors within the S&P 500. Now we're going to move to the healthcare sector. So healthcare is the second of 4 defensive sectors within the S&P 500. These are going to be drug makers, everything from drug makers to nursing homes to biotech companies. So companies like Johnson and Johnson, Pfizer, etc. Companies like United Healthcare, health insurance companies. And so we can see here, since 2010, the defensive healthcare sector ETF, my pick here is Vanguard VHT. This stock has outperformed the S&P 500 pretty strongly by about 50% over the years. So you can see that number that's there, or there maybe 322% versus 271% for the market. So it's been a strong performing sector in ETF. Let's get into this ETF and see what is included in it. So with Vanguard, one thing that we love is low expense ratios, and we have a 0.10 expense ratio on the stock. A little bit of a dividend yield, a little bit under the market, 1.45. Let's go right back. And so one thing that's interesting about the healthcare sector is, for the most part, these companies are going to be large cap stocks. A lot of these are some of the bigger companies outside of tech that weigh heavily within the S&P 500. But what I'll say is that within this holding or within this sector, there are both value stocks as well as blend stocks and growth stocks as well. And so this is one that has a good element of growth and even a bit of technology in it, which I think is viewed as a positive thing. There is a lot of technology that's within this healthcare sector. At the same time, we're also selling band-aids and includes nursing homes, so things that are very stable, but it's a very interesting sector. And so you can see that it has a quite high PE ratio of 26, higher than the market, which follows with a slightly lower dividend yield than the market because more future growth is expected, but a really high return on equity as well, all things considered. Taking a look at this, we can see some of the different sectors. So I'll name the largest ones. Biotechnology is at 19%, healthcare equipment is at 18%, life science tools and services, 11%, managed healthcare, 13%, pharmaceuticals, 28%. So pretty diversified. And we can see the names within this ETF. So United Healthcare, Eli Lilly, which has been on a tear this year, Johnson and Johnson, AbbVie, Merck, Thermo Fisher Scientific. I've done a video on that before. Pfizer, et cetera, et cetera. So a lot of big names with a lot of concentration towards those bigger names on the top. And so I think that covers this stock pretty accurately. Again, it's going to be a market cap weighted stock, which seeks to track the performance of a benchmark uh, index. Not working. Make it work. Okay, moving forward. So it seeks to track the performance of a benchmark index that measures the investment return of stocks in the healthcare sector, passively managed, also like that. So there's no emotions involved, using a full replication strategy when possible, and including stocks of companies in providing medical or healthcare products, service, technologies, or equipment. Vanguard. So now what we'll do is we're going to take a look at the third of four defensive sectors within the S&P 500. So the utilities sector. So are you going to pay that next light bill? Are you going to go to Disneyland, or are you going to pay your water bill? And so we can see why this is defensive. This is one that's really interesting. So this is predominantly electrical companies, but also, also natural gas companies, things of that nature. Anything that you can do to think of I have to pay this light bill or that water bill, these are those companies. And so it's underperformed the market pretty substantially since 2010. But you can see it has really low volatility. It also happens to have a really high dividend yield. So let's dive into this together. So a reasonable expense ratio, again, 0.10%. We can see there. Now, this is interesting. So this has a pretty high dividend yield of 3.8%. And we're going to talk about it more in a second. But the utility sector is the most bond-like equity that you can get. And so if you're a stock guy and you're looking for a ballast against volatility in the market, utilities can be a good place to sort of hide out. So seeks to track the performance of a benchmark of stocks that measure the investment returns of stocks in the utility sector, passively managed, full replication strategy, etc. Expense ratio there, pretty reasonable. And then let's look at some of these. Metrics that matter. So additionally, this company holds 65 stocks. These are large cap companies. So $32 billion is the average market cap. Pretty reasonable PE ratio of 18.3, but with lower returns on equity of around 9%. So not a lot of innovation happening in this area. So as we scroll down this, hopefully what we're going to be able to see are some of the holdings. So they might be names that you recognize. So companies like NextEra Energy, Consolidated Edison, um, and others that are escaping my mind right now. But basically, those are the stocks that it holds, and it holds them at a pretty high concentration. So we're going to look now at the fourth and final defensive sector within the S&P 500, which is Vanguard Consumer Staples Index Fund. So you can see here that it's a pretty smooth ride up into the right, but it's underperformed the market. Let's take a look at the expense ratio on the stock. So it is, thanks for sticking with me through the technical difficulties. Throw me a like, a sympathy like at this point. 0.10 expense ratio on the stock. A market beating yield of 2.5%. And so this stock is one that tracks consumer staple sector, passively managed, market cap weighted. And so we can see some other things here. We can see that the Vanguard Consumer Defensive ETF holds 105 stocks in it with an average market cap of $144 billion. So they're pretty much large cap stocks. A PE ratio of 22, which might be a little bit high historically. But return on equity of 26%, which is pretty cool. And so, as you can see here, the largest subsector within this area is kind of 4 or 5-fold, but consumer staples, merchandise retail, 21%, household products, packaged foods and meats, and soft drinks, non-alcoholic beverages, as well as a bit of tobacco in there as well, among others. So when we look at this, we're going to recognize a lot of names that are familiar. So Procter & Gamble, Costco, Walmart, Pepsi, Coke, Philip Morris, Mondelez, Altria Group, Colgate Palmolive, Constellation brand. And so this is your grocery store stock ETF. And now, folks, we're going to do something that I was a little bit shocked when I saw the results, and I think that you're going to find for it to be interesting. But I went ahead and I had to substitute out XAR to be able to look back a little bit further before the great financial crisis. But I've added these stocks to a cool tool called Portfolio Visualizer, which is a free service where you can back test different stocks and see how they'd perform against the market or against themselves at a given time. And so, if you haven't ever heard about this, service before, give me a like on the video and a subscription to the channel. I'd sure appreciate it. But we looked back as far back as we could go up until today's date in 2023. And I just crafted a more model portfolio representing these sectors, starting with $1,000, contributing $100 a month, without rebalancing, reinvesting dividends, showing the price versus the S&P 500 and displaying the income. So this is how I set it up. And so this is when I had to swap out. This is ITA. This is a little bit of a little bit of a more concentrated, conservative aerospace and defense ETF, as XAR is just a little bit newer. But I also have I have aerospace defense, I have healthcare, I have utilities, and I have consumer staples, all weighted at 25%. We're going to see something that's pretty interesting here. So what we can see is this went back to January of 2007. So the very beginning rubblings of the great financial crisis and recession that followed into 2010, 2011, up through today's date. And so when we look back on the recession and great financial crisis in the late 2000s, early 2010s, and then the COVID crash, as well as some of the tumult in 2018 and 2013 around the economy and the market, different interest rate environments, higher and lower interest rate environments, we can see that this equal weighted portfolio within the defensive sectors, going back to 2007 rather, we can see right here that it actually outperformed the market 9.14% to the market's 9.9%. And so, really importantly, I want to draw your attention to several of these years here. And so, what we're going to be able to look at is 2007, 2008, 2009, 2010, and 2011. And so when we look at these years, this is the banking crisis, the bailout of GM, the great financial crisis, the recession, 2009, 2010, 2011. And we can see this equal weighted portfolio of defensive sector stock ETFs would have outperformed the market in 2007. It would have had fewer losses in 2008. It would have not done as well in 2009, which was a recovery year. It would have done okay in 2010, and then at the tail end of the recession, it outperformed massively. So let's look at some of these numbers here. So in 2007, um, this defensive portfolio was up 16% to the market's 5%. In 2008, one of the biggest drawdowns in our living history, it had a 10% relative outperformance, declining 27% to the market's 37% decline. Additionally, 2009, it did okay. 2010, it did okay. But then in 2011, at the end of the recession, the market was up 2%. This was up 12%. And so it's really interesting to look at. As we look at all of these other years, there were some weird things going on with interest rates in 2013 and 2015. It had outperformance in those years as well. 2018 was a rough year for the market and for the economy. And so this one, by about three or four fold, had relative outperformance of the market. And then what we can see here, most instructive, 2022 is a big down year for the S&P 500, where it was down 18.2%, whereas this stock climbed 0.5%. So very, very interesting. And so generally, when you're looking at these defensive stocks, when the market does poorly, the stock will either hold its value or gain in value. But when the market returns and comes back stronger, it won't do as well. But over this period of time, we've seen that it's outperformed the S&P 500. So history doesn't necessarily repeat itself, but sometimes it rhymes. And I'm a stock guy. I'm 100% invested, but I do have some bearish proclivities. And so I own essentially all of these stocks. And it was something that I thought was important to bring and to share with you. And something for you to think about in the ways in which you could use this as the core or satellite of a diversified stock portfolio, based on your time horizon and risk tolerance and the fact that this is not financial advice. So one thing that is interesting and I suppose surprised me at first is this portfolio, because of the primarily because of the healthcare sector as well as the aerospace sector. Some companies there don't have the highest dividends. So this is essentially a market matching dividend yield of around 1.5%. And so this is not a dividend strategy by any means, but what this does um, is it reduces volatility. And so I wanted to bring another thing here to you. So we can see this utility sector. This has a 0.55% correlation to the S&P 500. So when the market zigs, utilities often zag. And they're down 13% this year. I'm going to be buying some more utility stocks through VPU soon. It's at a historically really low valuation, and I think it's a really good implement within a portfolio. But some of these other sectors, with only 0.79% correlation for consumer staples and so on and so forth, you can see, here kind of how these different sectors respond when the market's going up and down. And so this is looking at drawdowns, and what you can see is just a lot smoother of a ride at all points. For the most part, this portfolio is giving a little bit of a smoother ride based on your risk tolerance. Or if you're in that wealth preservation mode, you're not looking to grow wealth, but you need to preserve it. These can be some things for you to consider and for you to look at. So we'll go ahead and we'll end the video just by looking at the price performance of an equal weighted portfolio of these defensive stocks and just see that it's a little bit of a smoother ride at times. So thanks for tuning in. Make sure to hit like and subscribe on your way out.